If you are over 60, receiving Social Security, enrolled in Medicare, or planning to claim either benefit in the next few years, what I'm about to show you could be worth thousands of dollars that may already belong to you. And here's the problem. As of June 2026, millions of Americans between the ages of 60 and 80 are unknowingly leaving money inside the Social Security and Medicare systems because they assume the government automatically applies every benefit they're entitled to. It doesn't. In fact, some of the largest payouts available to retirees require a separate request, a separate application, or a specific question that most people never think to ask. The result is that many seniors spend years receiving smaller checks than they qualify for, while the money simply remains unclaimed. Today we're covering hidden payouts that are available right now in 2026, including one benefit that can permanently increase monthly income, another that many widows and widowers never realize they can use strategically, and a Medicare rule that can quietly remove thousands of dollars from your Social Security checks every year unless you know how to challenge it. And here's what makes this especially important. The Social Security Administration rarely contacts people individually to explain new opportunities, corrections, or overlooked options. In many cases, if you don't ask, nobody tells you. If you don't file, nothing happens. And if you miss the window, the money may never reach your bank account. For viewers born between 1955 and 1959, you're currently between 67 and 71 years old. For viewers born between 1946 and 1954, you're between 72 and 80 years old. These age groups are among the most likely to be affected by the rules we're discussing today, because many are already receiving benefits and assume everything has been calculated correctly. Sometimes it has, sometimes it hasn't, and the difference can be hundreds of dollars every month. Before we go further, take a moment to subscribe to Susan and turn on notifications. I say this every week because it's true every week. Government rules change, Medicare premiums change, income thresholds change, Social Security procedures change, but nobody from Washington calls your home to explain what changed and whether it affects your retirement income. That creates a dangerous situation for retirees. People discover new rules months after implementation. They find out about benefit adjustments after deadlines have passed. They learn about appeal rights only after they've spent years quietly overpaying. They realize money was available after it has already disappeared. This channel exists for one reason: to help you avoid silent financial losses. Not dramatic losses, not investment scams. The kind of losses that happen quietly in the background while you're busy living your life. A reduced check, an overlooked benefit, an unnecessary Medicare surcharge, a form you never knew existed. Those small mistakes can easily add up to thousands of dollars over the course of retirement. Now let's start with the first payout, because in pure dollar terms, this may be the most valuable overlooked benefit in today's entire discussion: the Social Security spousal benefit. This is where many married couples unknowingly leave money on the table for years. Here's the basic rule. If your spouse is receiving a Social Security retirement benefit that is significantly larger than your own, you may be entitled to receive a spousal benefit worth up to 50% of your spouse's full retirement benefit. Many retirees incorrectly assume Social Security automatically compares both records and automatically pays whichever amount is higher. That assumption causes problems. Because Social Security retirement benefits and spousal benefits are separate claims. Let me repeat that. Separate claims. Millions of retirees apply for their own retirement benefit and never ask whether they qualify for an additional spousal amount. Let's use a simple example. Suppose your spouse receives $2,400 per month in Social Security retirement benefits. Under current rules, a qualifying spouse could potentially receive up to $1,200 per month based on that record. That's not a one-time payment. That's potentially a permanent monthly benefit. Over a single year, that's $14,400. Over 5 years, that's $72,000. Now, obviously, individual situations differ. Eligibility depends on multiple factors, including age at filing and your own earnings record. But the important point is this: the Social Security Administration does not automatically call you and say, "You might qualify for additional money." You have to ask. That's why this payout continues to be overlooked even in 2026. Many couples assume everything was handled when they first filed for retirement benefits. Many discover years later that nobody ever evaluated whether a spousal adjustment could increase household income. And for retirees living on fixed incomes, an extra few $100s each month can completely change the monthly budget. It can help cover groceries, prescription costs, utility bills, property taxes, or simply provide breathing room that wasn't there before. If you're currently receiving benefits based only on your own work history and your spouse receives a noticeably larger Social Security check, there is one simple action you should take. Call the Social Security Administration at 1-800-772-1213 and specifically ask whether a spousal benefit adjustment applies to your record. Don't ask generally, ask specifically. Have both Social Security numbers available before making the call. That single conversation could reveal a benefit that has been sitting there the entire time while you assumed everything was already calculated correctly. And unfortunately, that's not the only place where retirees lose money, because the next category we're covering affects widows and widowers, and it involves one of the most misunderstood claiming strategies in the entire Social Security system. And in 2026, many eligible Americans are still missing it. Now let's move into the second category, because this is where many families unknowingly miss years of income. I'm talking about survivor benefits. If you're a widow or widower, this section deserves your full attention. Most people understand the basic rule. When a spouse passes away, the surviving spouse may be entitled to receive up to 100% of the deceased spouse's Social Security benefit, if that amount is larger than their own retirement benefit. What most people don't understand is that survivor benefits follow a different set of claiming rules than regular retirement benefits, and that's where opportunities often get missed. Right now in 2026, many widows and widowers are collecting less than they could because nobody explained the timing options available to them. Here's what makes survivor benefits unique. A surviving spouse can generally begin collecting survivor benefits as early as age 60. That's much earlier than many people realize. The mistake happens when someone assumes they must choose one benefit forever. That's not necessarily true. In certain situations, a surviving spouse can begin collecting a reduced survivor benefit while allowing their own retirement benefit to continue growing in the background. Why does that matter? Because delayed retirement credits can increase an individual's own retirement benefit by approximately 8% per year after full retirement age until age 70. Think about that for a moment. If your own benefit continues growing while you receive survivor income, you may eventually reach a point where switching benefits produces a substantially larger monthly check. Let's look at a simplified example. Suppose a widow turns 60 and qualifies for survivor benefits. Instead of waiting years with little or no Social Security income, she begins receiving survivor benefits immediately. Meanwhile, her own retirement benefit remains untouched. Every year, her own benefit grows. At age 70, she compares the two amounts. If her personal retirement benefit has grown larger than the survivor benefit, she switches. If the survivor benefit remains larger, she stays with it. Either way, she has potentially collected years of income that would otherwise have been missed. That's why understanding the switching strategy matters. The key point is not that every widow or widower should use the exact same approach. The key point is that many people never ask whether they have options. And when they don't ask, they often leave money on the table for years. If you're widowed and were born between 1956 and 1966, this is especially important because you're currently in the age range where claiming decisions can have major lifetime consequences. A single conversation with Social Security could potentially identify benefits that you've already earned but haven't claimed. That's why I encourage widows and widowers to call the Social Security Administration and ask specifically about survivor benefit claiming options, rather than simply asking whether they qualify. The wording matters, because the system usually answers the question you ask, not the question you meant to ask. Now let's talk about a completely different category of silent losses. This one doesn't involve missing benefits. It involves Medicare taking extra money out of your Social Security check every month. And many retirees don't realize the deduction can sometimes be reduced or eliminated. I'm talking about IRMAA. the income-related monthly adjustment amount. If you've never heard that term before, you're not alone, yet thousands of retirees are paying it right now. As of 2026, Medicare Part B starts with a standard monthly premium, but higher-income retirees pay additional surcharges on top of that amount. Those surcharges are called IRMAA adjustments. For many retirees, the first surprise is discovering that the government isn't using current income, it's using older income. Specifically, Medicare generally looks back 2 years. That means your 2026 Medicare surcharge determination is largely based on your 2024 tax return. And that's where problems begin. Imagine someone who sold a property in 2024, or received a large one-time bonus, or completed a business sale, or retired shortly afterward. Their current income may be dramatically lower than it was when that tax return was filed. Yet Medicare could still be charging them based on that older, higher number. The result? Their Social Security check shrinks before they even receive it. The money simply disappears each month, quietly, automatically, without any new paperwork arriving in the mail explaining that an appeal may be available. For higher-income retirees, these surcharges can range from approximately $1,148 to $6,936 per person annually, depending on income levels and Medicare brackets. That's real money, especially for married couples. Now here's the part most people never hear. Social Security created a specific form for this situation. Form SSA 44. Remember that number, SSA 44. The form exists for retirees who experience qualifying life-changing events. Examples include retirement, reduction in work hours, loss of income-producing assets, divorce, death of a spouse, loss of pension income, other significant changes that reduce household earnings. If approved, the government can recalculate your Medicare premium using updated income information instead of relying entirely on older tax data. In practical terms, that can potentially save thousands of dollars each year. Yet many retirees spend years paying surcharges they may not owe, simply because nobody told them the appeal process exists. That's exactly the type of silent financial loss I mentioned at the beginning of today's discussion. Money leaving your account every month, no warning, no explanation, no reminder. Just a smaller check. If you experienced a major income reduction after 2024 and you're paying IRMAA in 2026, download Form SSA 44 from ssa.gov or request it directly through Social Security. Then review whether your circumstances fit the qualifying criteria. Even if you're unsure, it's worth investigating, because once again, the difference between receiving the savings and missing the savings often comes down to a single question being asked. And the next payout we're covering may be even larger, because it involves retroactive payments averaging thousands of dollars for certain retired teachers, police officers, firefighters, and government workers. Many have already received these payments, others are still waiting, and some don't realize they're eligible at all. Now let's talk about a group of retirees who may be owed some of the largest retroactive payments currently being processed by Social Security. If you spent part of your career working in public service, this section is for you. Teachers, firefighters, police officers, certain federal employees, and others who earned pensions from jobs that did not pay into Social Security. For decades, two provisions known as the Windfall Elimination Provision, commonly called WEP, and the Government Pension Offset, known as GPO, reduced Social Security benefits for many retirees who also received government pensions. Millions of people spent years receiving smaller checks because of these rules. Then everything changed. In January 2025, the Social Security Fairness Act became law. The legislation eliminated both WEP and GPO, and the effects continue to be felt throughout 2026. Why is this important? Because the changes were made retroactive. That means Social Security has been reviewing records, recalculating benefits, and issuing back payments to eligible retirees. Some recipients have already received substantial one-time payments. Others have seen their monthly benefits increase permanently. According to reports released during the implementation process, average retroactive payments have been approximately $6,710, while average monthly increases have been around $360 per month. Let's put that into perspective. A retiree receiving an additional $360 per month gains more than $4,300 in additional annual income. Over 10 years, that's more than $43,000, and that's before accounting for future cost of living adjustments. For many households, that's the difference between constantly stretching a budget and finally having breathing room. Now here's where many people get caught. They assume that because the law passed in 2025, every eligible account has already been updated. That is not necessarily the case. Social Security has been processing millions of records. Some cases are straightforward. Others require manual review. Some involve older employment histories. Some require verification of pension information. As a result, there are still retirees in 2026 wondering whether their records have been fully updated. If you currently receive, or previously received, a pension from employment that did not pay into Social Security taxes, do not assume everything has been completed automatically. Call Social Security at 1-800-772-1213. Ask specifically whether your record has been reviewed under the Social Security Fairness Act. Ask whether any retroactive payment remains pending. Ask whether your monthly benefit amount has been recalculated. Those are 3 separate questions, and the answers could determine whether additional money is still owed to you. Again, notice the pattern we've seen throughout this entire video. The money doesn't come looking for you. The people who receive it are usually the people who know the rule exists and take one step to verify their status. Now let's move to the final payout. And while it may not produce a large monthly Social Security increase, it may be the easiest money to access immediately. In fact, some viewers may already have it available right now. I'm talking about Medicare Advantage over-the-counter benefits. If you're enrolled in a Medicare Advantage plan, pay close attention. Roughly half of Medicare beneficiaries now participate in Medicare Advantage plans. Many of those plans include an over-the-counter allowance. This benefit can be used to purchase eligible health-related products without requiring a prescription. Items commonly covered include pain relievers, vitamins, cold medicine, dental care products, first aid supplies, blood pressure monitors, diabetic supplies, and many other health-related necessities. The exact list depends on the plan. But here's the shocking statistic. A huge percentage of these benefits go unused every year. Not because people don't need the products, because many people don't know the benefit exists. Others receive the card in the mail, set it aside, and forget about it. Others assume it's a marketing promotion instead of an actual benefit attached to their plan. As of 2026, the average annual OTC benefit across Medicare Advantage plans exceeds $400. Some plans provide substantially more. In certain cases, annual allowances can reach $1,200, $1,800, or even $2,400. Think about that. A retiree could be paying out of pocket for health products while a funded benefit sits unused in an account connected to their insurance plan. And here's the part that frustrates many people. Unused balances often expire. Some plans operate on monthly cycles, others use quarterly cycles. Many do not allow funds to roll over indefinitely. If the benefit period ends, the unused balance may simply reset. The money disappears. Another silent loss. Another example of money that belongs to you but requires action to use. If you're enrolled in a Medicare Advantage plan, contact the member services number printed on your insurance card. Ask one question. What is my current OTC benefit balance and how do I access it? That's it. One question, 5 minutes. And you may discover benefits you didn't realize were available. Now let's bring everything together. Today's discussion wasn't about finding new benefits. It was about claiming benefits that may already belong to you. The spousal benefit that many married couples never properly evaluate. The survivor benefit strategy that can create years of additional income for widows and widowers. The IRMAA appeal process through Form SSA 44 that can potentially save thousands of dollars when income has fallen. The Social Security Fairness Act corrections that continue generating retroactive payments and higher monthly benefits for many public sector retirees, and the Medicare Advantage OTC benefits that expire every year because people don't realize they're there. 5 opportunities. 5 areas where retirees frequently leave money on the table. 5 examples of why staying informed matters so much in 2026. So here's your action plan. Don't try to do all 5 things today. Pick one, just one. The category that applies most directly to your situation. Make the phone call, check the benefit, review the form, verify your record. Take a single action before the end of this week. Because retirement finances rarely change because of one giant decision, they change because of a series of small decisions made consistently over time. And one phone call today could potentially increase your income for years. If you found this helpful, subscribe to Susan so you don't miss future updates involving Social Security, Medicare, retirement rules, fraud prevention, and government benefit changes affecting Americans over 60. And please share this video with a spouse, sibling, neighbor, friend, church member, or parent. One conversation can completely change a family's financial situation. You never know who may be missing a benefit, paying an unnecessary surcharge, or waiting on money they didn't realize was available. Thank you for spending these minutes with me. Stay informed, stay careful, and most importantly, make sure every dollar you've earned actually reaches you.